corporation is a type of business entity recognized in the US that offers limited liability to its shareholders and is treated as a separate legal entity from its owners. So, shareholders of a C corporations are typically protected from companies' liabilities, meaning their personal assets are generally not at risk for the corporation's debt and legal obligations. The C corporation exists separately from its shareholders, so this allows to enter into contracts, sue or being sued on property on its name and incur debt independently from its owners. C corporations face double taxation, where the corporation is taxed on its profits at the corporate tax rates, and then the shareholders are also taxed on any dividends they receive from the corporation. So let's understand the corporation's structure. The shareholders, they would elect the board of directors, and then the board of directors would elect the officers such as the CEO, the CFO, and then obviously these are the people, the officers, they run the company. Board of directors, they act as basically a control factor within the corporations, and the officers, they would elect or they would choose, they would hire employees for the operation of the corporation. So when forming a corporation, prospective shareholders exchange money, property, or both for the corporation's capital stock. For federal income tax purposes, a C corporation is recognized as a separate tax-paying entity. A corporation conducts business, realizes net income or losses, and pays taxes and distributes profit to its shareholders. The profit of a shareholder is taxed to the corporation when earned and is then taxed to the shareholders when it is distributed as dividends to them. Now, this creates a double taxation. The corporation does not get a tax deduction when it distributes dividend to its shareholders, and shareholders cannot deduct any losses of the corporation as well. A corporation must file a form called 1120 US Corporations Income Tax Return to report its income, gains, losses, deductions, credits, and to figure out the income tax liability for the corporation. Let's understand the double taxation for corporations. So let's say we have a corporation here, Conrad Corporation, which has a net income of $100,000 this year. Now we must note that they must have paid 21% corporate tax rate on their taxable income, and that's how they arrived at this $100,000. So they have already paid their income taxes. Now let's say they are owned by certain shareholders, okay, one individual who is a 25% shareholder, and then we have the other individual, again a 25% shareholder, the shareholder B. Another individual, shareholder C, also owns 25% of the corporation, and then we have another corporation who is being a 25% shareholder, ABC Corporation. They also own this company. So these are the four shareholders, 3 individuals and 1 corporation. They own this Conrad Corporation. Now we need to understand this $100,000 net income earned by Conrad Corporation eventually goes to each of the shareholders as dividends. Let's say they basically distribute all of their net income this year. So in such case, shareholder A, B, and C, all of them get $25,000 each. All right, and the shareholder ABC Corporation also get $25,000 as dividend. Now the corporation, the shareholder, the ABC Corporation, okay, this is owned by another 2 individuals, X and Y, okay, both owns 50% of ABC Corporation. So this $25,000 dividends earned by ABC Corporation from Conrad Corporation eventually would be distributed to their shareholders X and Y. Since they are 50% shareholders, they get $12,500 each. Okay, so now Let's see the taxability. On the individual A, when he or she receives $25,000 dividend income, they must report this dividend income on their Schedule B, and it would be taxed at their marginal tax rates. Now let's say individual A is a taxpayer who has a 25% tax rate. So on the $25,000 that the dividend received, he or she will have to pay 25% taxes on that. So that will make to 6,250. For the individual B is a 30% taxpayer. So therefore, on the $25,000, she or she will have to pay 30% of 25,000. And then individual C, who is a 35% tax bracket individual, for the $25,000 dividend income from Conrad Corporation, he or she will have to pay 35% tax rates on that. And then when it comes to the corporation, ABC Corporation, when it receives, since it is a corporation, it also will have to pay 21% tax on the $25,000 dividend received from Conrad Corporation. So that'll be 5,250. Alright, so now ABC Corporation is owned by two individuals, X and Y. X has the marginal tax rates of 30%. X has to pay 30% on the 12,500. Also, Y, who is a 35% tax bracket individual, will have to pay 35% on the 12,500 earned as a dividend from ABC Corporation. So this is how the double taxation or multiple levels of taxation for the C Corporation. Now this is the biggest problem with the C Corporation. You see that the same amount of income is taxed to different individuals at multiple times, creating a triple level or multiple level of taxation for the corporation. Corporations must file its annual income tax returns on Form 1120 unless they fall under certain Section 501 exempt category, regardless of their gross income or taxable income. So therefore, all domestic corporations, including corporations that are in bankruptcy, must also file an income tax returns whether they have taxable income or not. All domestic corporations must file Form 1120 unless they are required to elect or file a special kind of returns. So what are the deadlines for 1120? Corporations must file its annual income tax return 1120 unless they are specifically exempt category regardless of their gross income or taxable income. They must continue to file even if there is no activity and they only have cash to pay state taxes. Now, generally, a corporation must file income taxes on the 15th day of the fourth month, being a calendar year corporations. Now, as we understand that corporations can choose their taxable year other than the calendar year as well. Now, due date for the calendar year corporations are going to be 15th day of the fourth month, which means it's going to be April 15th. Consolidated tax returns. Affiliated group of corporations where a corporation having 80% or more ownership may elect to file a consolidated tax return instead of filing separately. Now, affiliated group is a group of two or more corporations that are related through common ownership, consist of a parent or one or more subsidiaries, and the parent must own at least 80% of the subsidiary stock and consolidate the subsidiary's financial statement with its own. By filing a consolidated tax returns, the group can offset profits and losses across the group, simplified compliance and filing, and then intercompany transactions, exclusions are other options when filing as an affiliated group. When it comes to C Corporation's taxable income, the concept of gross income is very similar for both corporations and individuals. The general rule is that income is recognized when it is received. So for a gap income, cash received in advance of accrual gap income is taxed, such as interest income, rental income, royalty income, when they have received in advance. Also, some of the gap income items are not really included in taxable income, such as the interest from municipal bonds, state bonds, and then certain proceeds from life insurance in case of a corporate officer's scheme and policy where the corporation itself is the beneficiary. And also we do not have a separate capital gain tax rates for corporations. Corporate capital gains are taxed at the same tax rate as the ordinary corporate income. So there are no special capital gain tax rates that would apply to corporations. When it comes to business deductions, all of the ordinary and necessary expenses paid or incurred during the taxable year in carrying on a business activity are deductible, such as salaries, office rentals, office supplies, traveling expenses. All are deductible when it is incurred for business purposes. Now, there are special rules for compensation to officers. Now, a publicly held corporation, they cannot deduct compensation expenses over and above 1 million paid to a covered employee, such as the CEO, CFO, and any other three most highly paid, highly compensated officers. Now, these covered employees remain as covered employees for all of the future years as well. Let's see one example. Concord City Corporation pays the following annual salaries to its top executives. So CEO is paid 1.8 million, and then the CFO is paid 1.4 million. COO, another highest paid officer, okay, he is being paid 1.2 million. The sales manager is paid 1,030,000, and the marketing manager is paid 1 million. Okay, so we have these many individuals, officers. These are the people who are paid high in the corporation. So let's see the deductibility. So total deductible compensation, we have 5 people. It's limited to 5 million. Okay, per so that's going to be 1 million per covered employees. So total non-deductible compensation hereby would be 1,430,000. So you can only deduct 5 million. You cannot deduct the excess of 5 million. That's going to be 1,430,000. Let's see the deductibility. CEO has been paid 1.8 million, of which only 1 million compensation can be deductible. So the remaining 800,000 is non-deductible. The CFO, he's been paid 1.4 million. Out of the 1.4 million, the 400,000 is non-deductible. And the COO, the Chief Operating Officer, he's been paid 1.2 million. Okay, of this 200,000 is non-deductible. The sales manager, he's been paid 1,030,000. So it's about 30,000, right? So this 30,000 will not be deductible. The marketing manager, he's been paid 1 million. So the entire amount up to 1 million could be deductible. So these are the ways that we can deduct. So we have 5 highly compensated employees. Each how much ever you can pay. You can pay how much ever you want. But what is deductible is limited to 1 million per person per year. The corporation can deduct the total salaries and wages paid for the tax year. Now, when it comes to bonus and vacation pay for an accrual basis taxpayer, it must be deductible only if it has been paid within 2.5 months after the year end. Life insurance premium is deductible if the insured employee names as the beneficiary. Fringe benefits provided to employees are mostly fully deductible. Now, when it comes to bad debts, an accrual basis taxpayer must use the specified charge-off methods, often called the direct write-off method, for tax purposes. Thus, the most taxpayers will have to write off bad debts as they become worthless or partially worthless. Bad debts on cash basis taxpayer has not been included in the amount of gross income, as bad debt is not deductible except in case of any uncollectible check that has been deposited and recorded as income. When it comes to interest expense, there are peculiar specific rules that the corporations must follow in order for them to be deductible. So most interest paid or accrued during the taxable year on any of the debts incurred for business purposes are deductible, although certain limitations may apply. Now, the deductions on business interest expense is capped at the total of, or the sum of, the business interest income plus the 30% of adjusted taxable income, often called the ATI, plus any floor planning financing interest expense. So the business interest expense is deductible, okay, limited to the sum of all of these three: business interest income plus 30% of ATI plus any floor planning financing interest. The adjusted taxable income refers to the taxable business income for the year, which does not include any interest income and interest expense. Floor planning financing is a form of debt that is commonly used to get motor vehicles that are intended for sale or lease. The debt is often secured by the inventory of vehicles that have been obtained. Then business interest expense that are not allowed this year might be carried forward indefinitely without any limits. The limitation does not apply to the taxpayer's average annual gross receipts for the past 3 taxable years are 30 million or less. So disallowed business interest expense can be carried forward indefinitely. Now these limitations, this 30% ATI limitations or floor planning limitations, this does not apply to smaller corporations which has got gross receipts of 30 million or less in the last 3 preceding taxable years. Let's look at a simplified scenario to illustrate this particular rule. James is a sole proprietor who runs a bakery with an average gross receipts of $500,000 over the past 3 years. So since he has a business loan, he has to pay interest on that, and his business loan has paid a $5,000 interest on his loan during the year. And now since James' gross receipts are below 30 million, he can fully deduct the $5,000 interest expense on his Schedule C, reducing his taxable business income. Let's see another example which is subject to a limitation, right? So Alexander owns a construction business that averages 40 million in gross receipts over the past 3 years. So he comes under the limitation. Now let's see the scenario. Alexander has an adjusted taxable income of 5 million for the current year, and he has a $300,000 in business interest expense. Now his interest deduction is limited to 30% of his ATI, which is going to be 30% of 5 million, which is going to be 1.5 million. Since he has only 300,000 interest and that is below the 1.5 million cap, he can deduct his entire 300,000 as business interest expense. Now we have discussed James' scenario. He was running a small business that qualifies for the exemption. He does not have to go through this limitation because he is well below the 30 million threshold for the current year. So he can get a full deduction of his interest expense. Under this scenario, where Alexander also can deduct the whole amount because he's well below the 30% or the 5 million threshold, so he also can deduct all of his interest expenses. Now otherwise he would have to see this 30% of his ATI limitation, plus he has to see what is his business interest income, plus he also has to see if he has got any floor planning interest. So limitations are based on that. Corporations making contributions to qualifying charitable organizations are allowed a maximum deduction of 10% on their taxable income. Any disallowed charitable contribution this year may be carried forward for up to 5 years. Let's see one example. Concord City Corporation has a 1 million in taxable income. Before considering any of the charitable contributions or any other carryovers contributions from previous years, the corporation now donates $180,000 to qualified charities during the taxable year. The maximum deduction allowed for charitable contribution is 10% of the taxable income. So in this case, we have a maximum of 10%, 1 million, which is going to be $100,000. So now the corporation can deduct up to $100,000 in charitable contributions for this tax year. So the excess, the 80,000, the remaining 80,000 can be carried forward for the next 5 years, subject to the same 10% limitation in each of the subsequent years. Casualty losses related to businesses. Generally, any loss sustained during the taxable year and not compensated by insurance is otherwise deductible. The loss may be treated as an ordinary loss or a capital loss depending on the type of the asset involved in the casualty scenario. Business casualty losses are treated differently from losses by the individual in a federally declared disaster issue. Now, for assets being partially destroyed, the loss is limited to the lesser of the decline in the value of the property or the adjusted basis of the property immediately before the casualty. Now, for the assets which are fully destroyed, the property has been fully destroyed, the amount of loss is the adjusted basis of the property. The organizational and startup cost deductions. A corporation may elect to deduct up to $5,000 of organizational cost and startup cost. Each $5,000 is reduced by an amount by which the organizational startup cost that exceeds $50,000 respectively. So any excess organizations or startup cost that would be amortized over 180 months, beginning with the month in which the active trade of business begins. When it comes to amortization, depreciation and depletion, the corporation will follow the same rules as any other trade or business. Goodwill, covenants not to complete, franchises, trademarks, and trade names, these are intangible assets. They must be amortized on a straight line basis over a 15 years period, beginning with the month in which such intangible was acquired. For deductibility of life insurance premium, where corporation is the beneficiary of a Cayman policy, those premiums are not deductible for the corporation. Now let's say the beneficiary is the employee, then those premiums paid on these insurance policies would be deductible by the corporation as the employee is named as the beneficiary. Business gifts are deductible up to a maximum deduction of $25 per recipient per year. Now, business meals may be deductible up to 50% by the corporation. Business entertainment expenses are not deductible. Penalties and illegal activities, oftentimes they are not deductible. These are bribes, kickbacks, fines, penalties, and other payments that are illegal under federal law and under generally enforced state law. These are not deductible. Payments made related to sexual harassment or sexual abuse, any settlement payments or related attorney fees related to sexual harassments or abuse are not deductible if the settlement of payment is subject to non-disclosure agreement. Lobbying expenses incurred in attempting to influence local, state, or federal legislation are not deductible. So any of the political contributions are also not deductible. Capital losses. we have the rule of $3,000 which are available for individuals, right? They can basically take it against other ordinary or portfolio income oftentimes. Now these provisions are not allowed for corporations. Thus a corporation can only use a capital loss to offset their capital gains. If they have excess capital losses, they may be carried back 3 years and carried forward 5 years. They can deduct the taxes. These are all state and local taxes and federal payroll taxes. These are deductible when incurred on property or income related to a business. Federal income taxes are not deductible by the corporations. When it comes to inventory valuation methods, the tax method used for accounting purposes can be used for income taxes purposes also, provided that the method clearly reflects the income and is consistent in application. A change in inventory method is considered as a change in accounting method, and therefore this must be approved by the IRS. So we have basic valuation methods. These are cost method, lower cost of market method, rolling average method, retail method, FIFO first in first out, or a LIFO last in first out. We also have a dividend received deduction, often called the DRD provisions for only for corporations. So the domestic corporations are allowed a dividend received deduction based on a qualified dividend income. Now the purpose of DRD is to prevent the multiple levels of taxation in earnings of the C corporation. The amount of dividends received deduction allowed depends on the percentage of investee corporation owned by the investor corporation. The percentage allowed may be either 50, 65 or 100%. DRD is only available to C corporations, as we know. Shareholders must own the stock more than 46 days during the 91 days period, beginning on the date 45 days before the ex-dividend date. The DRD rules does not apply to preferred stock. Now let's see, if the percentage of ownership is less than 20%, the DRD is going to be 50%. If it is more than 20 but less than 80%, DRD is 65%. If the ownership is more than 80%, you control the company, so therefore the DRD, dividend received deduction, is going to be 100%. So that needs to be clarified. So let's work out on an example to understand this specific rules. Conrad City Corporation or C Corporation holds 25% stake in Newtown Corporation, which is another C Corporation. Newtown Corporation distributes dividends to Conrad City Corporation and receives $100,000 dividends. So since Conrad City owns 25% of Newtown, it qualifies for a 65% of DRD. So how do we calculate this? $100,000 of dividends times the 65% makes it $65,000. So you can exclude that $65,000 as DRD. So you may have to report the $100,000 dividend, but you would get a reduction or deduction as DRD 65,000. So therefore the taxable income, ultimately what you're going to show is $100,000 minus the $65,000 DRD, which is going to be $35,000. So the Conrad City only needs to include $35,000 of income in its taxable income instead of having the full $100,000 as income. As we understand, the dividend received deduction is only available for corporations, so these are not available to other entities like personal service corporations, personal holding companies or S corporations. We have specific rules with regards to DRD limitations, often called DRD taxable income limitations. So the dividends received deductions, the DRD equal to the lesser of 50 or 65% of dividend received or 50 or 65% of taxable income computed without regard to DRD, any net operating losses carry forward or any capital losses carry back. So these exceptions will not be applied if the taxable income limitation, if taking the full dividends received deduction results in a net operating loss for the entity. Let's work out an example. Conrad Company owns 40% of Tulip Corporation. So therefore, since Conrad owns 40%, 65% of DRD applies. Now, based on the below scenarios, calculate the dividend received deduction. Below are certain alternative situations for the year. So the dividend received deduction and taxable income would be calculated based on the scenarios. Let's see. So we have the gross income operating revenue of 250,000, dividend income of 100,000 makes the total revenue to be 350,000. We have the deductions 200,000. So your taxable income before dividend received deduction is 150,000. So now we have to apply the 65% of DRD. Now we have to now choose between 65% of dividend income or 65% of taxable income before DRD. Now we have two choices. Now the choice depends on whether it makes a net operating loss or not. So if it makes a net operating loss, we would just stick on with 65% of dividend income. If it doesn't make, then we'll have to see what is lesser. Okay, if you apply 65% of dividend income or if you apply taxable income before DRD, whatever is lesser, that's your DRD deductions. So in this case, let's see. So we have deductions 200,000, taxable income before DRD is 150,000. So you're going to apply the DRD percentage 65,000 on 100,000 dividend income. So that's going to be 65. Then if you apply 65% of taxable income before DRD, that will be 98,000. Okay. So whichever is lesser, obviously 65 on 100,000 dividend income, you would apply that. So therefore taxable income is going to be 85,000. Now let's see the second scenario. In the second scenario, you see that taxable income before DRD is 90,000. Okay. And dividend income is 100,000. What is lesser? Taxable income before DRD. So therefore, since it doesn't create a net operating loss, you would apply the 65% of the lesser of the two. So that means you would apply 65% of taxable income, 59,000. So therefore, your taxable income is going to be 31,000. Let's see the third scenario. Here you have the operating revenue 250 plus 100,000 dividend income makes it 350 total revenues, less deductions 290. Okay, so therefore your taxable income before DRD is 60,000. Now you see that if you apply the 65% DRD, that's going to get you a net operating loss of 5,000. So therefore you will not do the lesser of the two. You will stick on with 65% of dividend income itself. Okay, so this is how it goes. You have deductions of 290, which makes it taxable income 60,000. And then we had two choices. One is to take 65,000 or 39,000, which is basically 65% of your taxable income before DRD, but you don't do that because it creates a net operating loss. If it creates a net operating loss, you will stick with the rule number 1, which is going to be 65% of dividend income. So therefore you apply the DRD 65,000 and therefore your taxable income is going to be 5,000. So in the second scenario, we have lesser of 65% of dividend received or taxable income before DRD. So lesser of 100 or 90, and there was no NOL created, so you would take the lesser of the two. And in the third scenario, when subtracting the full 65% of DRD, a net operating loss was created. So therefore you will stick on with rule number 1, which is 65% of the dividend income. Okay, so the taxable income before DRD limitations does not apply in this case. So your net operating loss deductions, you could carry back 5 years and carry forward indefinitely. This was the rule from 2018 to 2020, and then 2021 onwards the NOL deductions are limited to 80% of future taxable income. So you cannot offset the 100% of taxable income for the future, but it is limited to 80% of taxable income, but it can go indefinitely. Okay, this is how you would deduct your net operating losses.